All right, so chapter 26 is about capital investment decisions. This means putting money into long-term assets. That's what we mean when we say capital investments, okay? I guess I'll tell you that right there. An operational asset used for a long period of time. The investment's the acquisition of that, and budgeting is the process of planning for that, right? Hopefully business owners don't just like randomly decide like I'm going to buy $1 million piece of equipment. Instead, they have a plan in place. We're going to buy this piece of equipment. We expect it will last this long. We expect it will generate this many units, whatever, right? That's capital budgeting. There's the capital budgeting process. I won't read it to you. In fact, we'll just kind of go on by. Of course, you can look at it for a moment if you will. Enjoy. All right. Capital rationing, again, I mean, that's kind of obvious, right? When you ration stuff, you kind of recognize you don't have money to buy everything you want. You can't buy every piece of equipment and every cool new gadget that you want, so you make plans and work according to those. And the post-audit is the way you look at the end and say, well, did this thing actually make the money we projected it would, or did it not, etc. All right, so really what this chapter is about is how we analyze the potential of an investment, how we decide whether or not investing in that new piece of equipment or that new building or whatever is a good deal or not a good deal, or how do we compare multiple potential investments if we're rationing to decide which one makes the most sense. So there's 4 methods that are used. I'm going to show you how to do them just a little bit, but I'm also going to show you how to use Excel. Excel has functions for this that will make your life a lot easier. So anyway, we'll look at them. All right. So again, this is just more informational stuff. Stages of capital budgeting. You look at the potential investments. Use these methods we talked about. Anyway, you can read it. What really matters is how you do the work. All right. So when we speak of capital budgeting, we don't focus on net income, we focus on cash flows, okay? How much cash flows out when we purchase a big investment, how much cash is going to flow in from the investment. And that inflow can result in either increased revenue that we collect in cash or decreased expenses. Either of those would give us an increase to our cash flow, okay? I should say decreased costs. Right? Expenses are always confusing as to when they're cash flow or when they're not. All right, and then they have the life cycle of capital investments, which is kind of obvious. The initial investment is an outflow. Then during its lifetime, there's revenues generated, which are inflows, operating costs incurred, which are outflows, refurbishment, repairs, maintenance, outflows. There's something not on that list. There's also expenses saved, outflows, right? Sometimes if you buy a piece of equipment, maybe it'll do the job of 5 employees or something like that. And so those employees either get laid off or move to another division or something like that. That also creates positive cash inflow to you in the sense that, or it reduces outflow, I guess. And then there's the residual value. But, if you can sell the asset for something at the end of its life, that's a cash inflow. So this is important, and you'll see why it's important in a minute, that you recognize when you invest, cash goes out. During the life of it, there's usually inflows and outflows. And at the end, there's usually some sort of inflow. You can scrap it at least, or make a little bit on it. So that's going to come into play as we start to analyze the value or the how good an investment is or isn't. All right. So the first 2 methods, the payback method and the accounting rate of return method, are the simpler methods of the 4 that they're going to show you in this chapter. So payback is the amount of time it takes you for an investment to pay back the initial cost. Okay? So if you think about that, it's pretty simple. So here's an example. They're considering investing $240,000 in hardware and software for their business. They expect that this hardware and software investment will save them $60,000 per year for each of the 6 years of its useful life. So your initial impression would be $240,000 investment, 6 times $60,000 in cash, positive cash. So I'm going to invest 240, I'm going to get 360, sounds like a good deal, right? And maybe it is a good deal, but there's some things that you want to do to kind of check that out. So net cash flow is when there's an increase in revenue and a decrease in expenses, or both. So to do payback, here's the formula. All you do is you take the amount you invest and you divide it by the expected annual net cash inflow. So that's annualized. The total amount invested divided by the expected annual net cash inflow. So in the case of this one, $240,000, expected to make a net cash inflow of $60,000 per year. It's got a 4-year payback. So you can see if you had multiple investments that you were trying to decide between, this would be a super quick and easy way to evaluate them and say, how long does it take to pay back, right? So here's another example. Maybe now they decide instead of doing this, they'll invest $240,000 to upgrade their website, and their analysis says that upgrading the website is going to generate an additional $80,000 a year in net cash inflows. So for this one, you'd say 240 divided by 80 has a payback of 3 years. So that looks more attractive in terms of payback than the first investment. So this is just a little, I guess, a payback schedule. If you look at it, it just breaks down. Both of them had $240,000 in initial outlay. And then the B2B portal, they just do by year, $60,000 a year, and then it accumulated 60, 120, 180. So by year 4, they've matched their outflow. And here is 80 a year, so by year 3, they've matched their outflow. That's all that's showing. It's like a schedule to track it. Maybe they're looking at another potential investment, but this one doesn't bring in the same amount of money each year, right? They expect it will give a net cash inflow of 100,000 in the first year, 80 in the second, 50, 50, 40, 40, 30. So now you've got this issue of like, it's not an even number of years. People get confused by that. In other words, by the end of year 3, it's paid back 230,000. By the end of year 4, it's paid back 280,000. So we know that, or is it 3 and 4 or 4 and 5? Anyway, so we know that the payback is somewhere between 3 and 4. So all you do is you take 3 years plus the amount left over, which was 10,000, divided by the amount of cash inflow for that year. It's going to give you 3.2 years. So you're going to have a problem where you have to figure this out, and you're going to be like, I don't know, because it doesn't come out evenly. Well, that's how you do it. You do the total number of years. So at the end of 3 years, it hasn't quite paid itself back. You know, you need another $10,000 to do the payback on the 240,000. So you take the 10,000 divided by the $50,000 it's going to make next year, and that's 0.2 of that year. Add it to the 3, it's a 3.2 year payback. Okay. So now we have our payback period for the 3 competing investments. The website upgrade is 3 years. The Z80 portal is 3.2. The B2B portal is 4 years. So from the standpoint of payback, the upgrade looks like the best deal. Does anybody, just from my description of it, can anybody think of a possible limitation of the payback method or a possible complaint about it? So look at the 3 different investments. This one's going to pay back $60,000 a year for 6 years. This one's going to do $80,000 a year for 3 years. And this one's going to do 180, 50, 50, 40, 40, 30 for 6 years plus the residual amount they can get back. According to Payback, the website upgrade's the best one, the 3-year. So that only brings in $240,000 in total cash inflows. It does pay it back fastest, but then it's done making us money. This one brings in $360,000 in total cash inflows. So even though the website upgrade paid us off faster, this one's going to actually bring in more money to us. So one of the limitations of Payback is it's not concerned with total amount of positive cash flow in the future. It's only concerned with how quickly you pay back the amount you invested. maybe if I can take another year to pay back the amount I invested, if it's going to continue to make money beyond that, maybe that's a good thing. So that's a limitation. So there they've given you a handy bar chart in case you weren't clear on what 3 years, 3.2 years, and 4 years meant. Now you can see it graphically. And in essence, here's the rule. With payback, the investment with a shorter payback period is more desirable, all else being equal. So there's a reason we have 4 methodologies for sort of looking at these capital investment decisions, is because any one of them has limitations. So instead what you do is you do all 4, and then you use that to sort of make your decision in the end, right? Well, this one has a shorter payback, but this one has a better net present value or whatever, okay? All right, so the second one is called the accounting rate of return. The accounting rate of return is just, it takes our average annual operating income divided by average amount invested. The term average amount invested is confusing. And if we just invest a single amount, which most of these are, then that's our average amount invested. If we had to invest over a period of time, right, we could average it. But most of the problems you'll see, it'll just be the amount you invested. So before calculating the ARR, first determine the average annual operating income using the following formula. So it's the total net cash inflows minus the depreciation during the operating life of the asset, which gives you the total operating income during its operating life. You divide that by the operating life in years, and that will give you the average annual operating income for the asset. That means how much operating income did the asset generate per year during its life on average. Okay? So you take that divided by the amount you invested, and you get 16.7%. So that's the accounting rate of return on that asset. You can do the same on the Z80 portal. Net cash inflows, so you added up all the inflows, minus the total depreciation, gives you the total operating income. Divide that by its years, its useful life, gives you an average of $25,000 a year. Divide that by the amount invested, you get 18.5%. So it's like anything else in this class, right? The math isn't like super hard. It's the classifying it and knowing which number to pull from where to use that always gets confusing. So the rule is on the accounting rate of return, if the expected accounting rate of return meets or exceeds the required rate of return. So in these problems, they'll tell you the company's required rate of return on capital investments is 12% or something like that. So if the accounting rate of return meets or exceeds that, then it's something that you want to invest in. It means that this thing is giving you a rate of return greater than what your target or required rate of return is. When you have competing interests in a business, in essence, what you have to do is say, how much money am I making in my current operations? And if I pull money away from those operations to invest over here, shouldn't I want to at least make the same rate of return that I'm making over here? Or else it's not worth it, right? So most companies will set like a target rate of return, or sometimes they'll call it a hurdle rate, meaning we're going to evaluate all new investments to see if they earn a rate of return at least as good as or better than that target rate of return. If it doesn't meet the required rate of return, then do not invest in it. All right, so the other 2 methods involve using the time value of money, which is something we touched on very, very briefly in Accounting 1. The idea behind the time value of money is that a dollar received today is worth more than a dollar to be received in the future. In other words, if I give you $100 today, that's worth more than $100 that I give you a year from now. Why is that so? What's that? Okay, yeah, so there's an emotional sort of value, like I can use this to pay expenses right now, as opposed to hoping to pay expenses in the future. I don't even know if I'll have a business a year from now. So there's that type of value. But there's also a clear financial reason why having money today. What's that? Okay, because and that's an uncertainty actually. We don't know what it's going to be next. But it's even simpler than that. Inflation is this kind of big macro kind of concept. So that's another reason. So now I've got two reasons, which weren't the ones I anticipated, but they're not wrong. So what's another one? Yeah. Interest. Or whether it be interest because I put it in the bank or interest because I'm earning a return on it by investing it into the business in some way. If you think about it, if I can earn 8% on $100, if I get it today and hold it for a year, I've got $108, right? Whereas if I just get $100 in a year, I've only got $100. So the amount of interest or the rate of return that I can earn impacts the time value of my money. So if you think about that, it's our principal times our rate times our time, right? We already learned about that. That equals a future value. The amount of money I'm investing times whatever interest rate it's going to earn times the amount of time it's sitting there, it's going to give me a future value. Sometimes instead of principal, they use the term present value. The present value of the money, what it's worth right now, times the rate, times the time, gives me the future value. Well, for these concepts, instead of worrying about what future value is, what we do is we solve for the present value. So the present value of money equals the future value divided by rate times time. Here's the idea. If I'm evaluating two investments and they're going to bring me cash flows way out in the future, maybe some cash flow each year for the next 5 years or something like that, what terms can I put it into so I can compare it? And the answer is I can put it into present value. I can figure out what today's value of that future cash flow might be. And then I can compare everything on equal footing. Like when someone wins the lottery and they say, you can have $1 million today or we'll pay you $2 million spread out in increments of $100,000 a year for the next 20 years, which is the better deal, right? They're both pretty good deals. But which is the better deal? Which is going to give you more money? Well, the present value of $1 million today is $1 million. The present value of future cash flows of $100,000 a year for 20 years is going to be some amount less than $2 million because we have to multiply it by a factor that will reduce the value for each year that cash flow comes in. And I'll show you how we do that, okay? So the net present value method is one way that we compare between two capital decisions, and the other is what's called the internal rate of return. All right. So there's all the stuff I just said. Several key factors in the time value of money: principal, the number of periods, and the interest rate. Principal times rate times time, right? All right. Much of what we've done in this book and in both classes has been simple interest, right? In other words, an investment pays 6% on the principal, and then it pays out the interest, and it just continues to pay 6% on the principal, like when we did bonds payable and stuff like that. But in real life, most things pay compound interest, meaning if at the end of one year I had $108, then the next year I'd earn 8% on the 108, right? Which would be 8 plus 64 cents. So the next year I'd have 116.64. And then the next year I'd earn 8% on that whole amount. That's compounding, where the interest earns not only on the principal you started with, but on the principal plus the interest. And over time, that really adds up. So you can see an example here where we have $10,000 earning simple interest of 6%. So each year it earns $600. And at the end of 5 years, you have $3,000 in total interest. So in the end, you have $13,000, right? The $10,000 you invested plus the $3,000 in interest. With compound interest, in year one, it's $600. In year two, it's $636, and so forth. And at the end, you have $3,383. That makes a pretty big difference, just compounding, right? If you think about it, that is a factor of more than 10%. More money than you would have had if you'd done simple interest. So all of the things that we do when we're dealing with time value of money assumes compound interest. Okay. You also see how the math for compound interest is much more complicated because you've got to carry it forward each time. Not really that bad if you use Excel or something else that will just carry the formulas forward for you. All right. So the future value of an investment is simply the worth of the investment at the end of its term. That's the future value. People use that all the time for retirement planning, right? I'm going to put in $10,000 a year into my IRA. What's it going to be worth in 50 years if I earn 8% interest per year? So the present value, they just rearrange the equation. So we're talking about present value. So for future value, we'd say the principal plus the interest earned is $1,383. The present value then would be like, how much money do I need to invest today to have $13,383 at some point in the future? And of course, to figure that out, you'd have to know at what point in the future, how far down the road, and at what interest rate. And then you just discount it back. Instead of having to do all the crazy math, the chapter provides for you tables, which are they're called discounting factors. In essence, you can say this many periods, this much interest per period, this is the factor, you multiply it by the principal amount, and that gives you the present value. Also, you can use Excel. All right. So this in your book, you'll need these. There's two things you're going to deal with. First, there's the present value of $1. What that means is what is the present value of $1 discounted at of a single amount of money. So if I say 5 years from now, I want to have $10,000 and I can earn 8%, what's the present value of that? You use this table, present value of $1. The second table is called the present value of an annuity, or of an ordinary annuity. This is a series of equal future amounts. So now I'll say, if I want to have $10,000 in 5 years, how much do I have to invest each year for it to add up to $10,000? So an annuity is a series of equal future amounts, as opposed to a lump sum or a single amount, which is one single dollar amount. Okay? That'll come into play as you're trying to calculate these. Which table am I using? Okay? I know it's hard to, I'm just giving you the concept right now when you do the practice. That's how we always do it in this class. It'll be all right. So the first question is, how much would you need to invest today in the present time to have $13,383 in 5 years if the interest rate is 6%? Anybody have a hard copy of the book with them? Nobody does? We all use our ebook, huh? If we use our book at all. So the way we do that is we look up at Appendix B, Table B1. So first of all, let me ask you, are we talking about, we have two tables to choose from, future value of a single amount or future value of $1, or present value of a single amount, or present value of an annuity? Is this a single amount or an annuity? $50-50 chance. Just guess, somebody. And then I'll tell you wrong. Wrong. But good guess. All right. So here's how you tell the difference. Okay. How much would you need to invest today? It's asking for a single amount of money in the present time to have X amount in the future. So we're looking for the present value of a lump sum. What lump sum of money would I have to invest if I can earn 6% and I have 5 years? What amount do I have to put in so that it will grow to that in the future? This could be useful if you're like, I need this much to send my kid to college, and you have a big chunk of money. How much of this do I just need to put into the investment, right? That's when it would be useful. Yeah.
What would be like a common IRA?
Well, it depends on what you're investing in the IRA. IRAs can invest in anything. So I mean, you could have an IRA that invests in a certificate of deposit and earns 1%. You could have an IRA that invests in the market, and some years it's going to make 12%, and some years it's going to lose money. if you really, it depends on your time horizon. If you've got a 30-year time horizon, you're starting to plan, for retirement when you're 30 and you think you're going to draw the money when you're 60, then you could probably hope for somewhere between 8 to 12%, depending on how the market does. That being said, there's always risk involved in that. And what happens is the closer you get to retirement, the more risk averse you become. You can afford if it drops a little now while you're young, because you keep pumping money in there. But as you're 2 years away from retirement, you suddenly are moving the things, not suddenly, you're moving things out of market-based investments and into more fixed investments. Right now, fixed investments just aren't paying well. A 30-year bond is going to still pay you like 2.5% or something like that. There was a time when those things were paying in the 80s when they were paying 12 and 15% for bonds. But probably something more like 4.5 or 5 is if we ever stabilize, and it's been many, many years since the bond market and the stock markets have stabilized. It's been a long time since we could even get 5%. The interest rates have been super low. Like I was getting 5.5 or 6% on a 30-year bond yield back when I was doing it. So that was 1999 and 2000. That's about the last time. So that's 17 years ago. So the short answer to your question is it depends on what you invest in. And probably, like I try to use for when I was younger and it was in that environment, I was using 10 to 12% as a planning tool number. Now I use more like 6% as a planning tool number. And a lot of people are like, you're crazy, you're not going to get 6%. But I think I can do better than that. So I'm trying to be conservative. Does that make sense? All right. That was a really long answer All right. So what we do is we would go to our table, and in the table, it has interest rates, I think across the top, and number of periods down the side, and you would go to n equals 5, and the interest rate equals 6%, and you'd bring your fingers together, and that would give you a factor. And that factor is the amount you multiply the principal by, and that gives us our answer. So the present value of $13,383 for 5 years at 6% is $9,997. So that means if you put $9,997 in an account that earns 6% and it sat there for 5 years, you'd end up with $13,383. So the present value of an annuity is a series of equal payments. So assume that instead of receiving a lump sum at the end of 5 years, you'll receive $2,000 at the end of each year. So if I'll get $2,000 a year for 5 years, what's the present value of those cash flows? So the way you do it is the same way, except it's another table that shows the present value of an annuity. And you put the number of periods, the interest rate, bring your fingers together, it gives you a factor. And you multiply the amount of the cash flow by the factor, and it tells you the present value of that. So we see right here that $2,000 a year for 5 years at 6% is worth less than $13,383 received in a lump sum at the end of 5 years in present value terms. So hopefully now your brain can start to go to how this might be used for evaluating investments or capital investments. So, okay, here's your assume you've won the lottery after purchasing a $5 lottery ticket. I hope most of you don't play the lottery. We actually calculate the odds of winning the lottery in our stats class, and I've determined that the lottery is a tax for people who are not financially savvy. They're paying lots of money in. All right. So option 1, you get $1 million today. Option 2, you get $150,000 at the end of each year for the next 10 years. So you get a total of $1.5 million. Or option 3, you have to wait 10 years, but at the end of 10 years, you get $2 million. I'm like, what happens if I die in the next 10 years? Do my kids get? That'd be important to me to know. All right. So what we do is to find out the present value, is we would take so the first one is the present value of a lump sum where I equals 0 and N equals 0, right? Because we got the money today, which means the present value of $1 million today is $1 million. That's easy. The second one is the present value of an annuity because it was $150,000 a year payouts. So again, you go to the present value of an annuity table, you put N equals 10, I equals 8. Bring that together, it gives you a factor. You multiply that factor by the $150,000 and you come up with $1,006,500. Option 3 was present value of a lump sum. That one was 10 years as well. So I is 8%, N is 10. Go to the present value of a lump sum table, you find the factor, multiply it by the million, and it comes out to 926. So the present value, the option that gives you the best present value is option 2, which means if you were taking that $1 million and you were going to invest it in something and could earn 8% at the end of 10 years, that one's worth the most, okay? So neither of the first two methods, payback or accounting rate of return, recognizes the time value of money, recognizes that money received now is worth more than money received in the future. So that's the real strength of using present value, okay? The downside is it's more complicated, right? I confused you just trying to explain it to you. You're going to have to work with it a little bit to get comfortable with the idea, whereas the other one's pretty easy. I take how much it costs, I divide it by the amount it brings in, it tells me how, that's much more simple. So net present value is the concept using present value and netting it against the capital outlays, okay? The term they'll use is discount rate, which is sort of the same as management's minimum desired rate of return. So we're going to compare these two projects. The first is their laptop computer project. The second is their desktop computer project. These are the expected cash inflows from the two projects. Which one is better? Well, it looks like the laptop is, but let's see what net present value tells us. All right. So they expect the laptop project to generate $305,000 of net cash inflows for 5 years. So they calculate the net present value by simply taking the net cash inflow, multiplying it by the annuity factor because it pays the same amount each year, which gives us a present value of those cash flows. You subtract out the initial investment, and that gives you the net present value, or the present value of the positive cash flows minus the amount you have to pay out in the beginning. Okay? The decision rule is if net present value is positive, you do it. Why? Because you put in a target rate of return. So if net present value comes out positive, it means that this thing is returning better than your target rate of return. If it's negative, you don't invest. This one, this is the desktop because it brought in different cash flows each year. You can't use the annuity one. So instead, you have to do the cash flow for the first year as a lump sum of $500,000 with a time period of 1. For the second year, the cash flow, a lump sum of $350,000 with a time period of 2, etc. This one has a net present value of $78,910. If we think at the end of its 5-year life, we'll be able to sell off the project or whatever for another $100,000, then that's going to change because now we have the present value of the annuity. That's the money it's bringing in each year, plus the $100,000 we're going to get at the end. So that's a single lump sum of $100,000. There's the factor, N5, interest 14. And so now that's going to increase the overall present value of this. If this seems a little confusing to you, don't worry. It'll be even more confusing when you're doing the homework. No, it'll be easier as you're doing it, right? It always is. It's confusing at first, and then once you work through it, you're like, that was easy. That's why you all got A's on the last exam. Well, that's why 2 people did and blew the curve for the rest of you jerks. They're not really jerks. They're just doing their best, people. Doing their best. Like Riley's still mad about it. He's like looking around. So here you compare the two present value for project A, B, C, the initial investment, and the difference is the net present value. So all we're talking about when we're talking about net present value is saying how much is the present value of all the future positive cash flows of this investment minus the amount we had to pay in for the investment. That's the net present value. And that's a way to compare multiple investments that takes into account the time value of money. If you remember when we looked at Payback, the problem with Payback was that it didn't take any of that into account. It just said, oh, this one pays back faster, so it's a better investment, even though some of them continue to pay cash flow for years to come. So this takes all of that into account and takes into account the value of the money if you're using it in other places, that 14% return that they factored in. So this is a superior tool, but it's a more complicated tool. Tomorrow, before you start into the group work, I'm going to show you briefly how to use Excel to calculate net present value and internal rate of return. There's a simple function that's just equals NPV, and then you just have to know which items to include, and it'll calculate it for you. So another way we can compare these is to do what's called the Profitability Index, which is just the present value of the net cash flows divided by the initial investment. Remember, the net present value was the present value of the cash flows subtracted from the initial investment. This is just where you divide it. So it gives you another way to kind of compare it and look at them. Actually, so from a net present value standpoint, all three of these investments are a positive investment because they all are doing better than the required rate of return of 14%. Right? If I can earn better than 14%, I'm interested. If I only have the money to invest in one of them, then I choose the one with the best profitability. If I can invest in all three of them, I would. Why? Because they're all making better money than my base level I expect. We'll skip that. Let's talk about internal rate of return. So internal rate of return is the rate of return based on discounted cash flows. Remember we did the accounting rate of return, which is kind of a simplified version of how much positive cash or operating income is this investment bringing into me divided by how much should I spend on it. So this is the same idea, except it takes into account the time value of money. And so this is what it is in simple terms, but it's not so simple until you've worked with it. It is the interest rate that makes the NPV of an investment equal to 0. So if you can say my discounted future cash flows subtracted from my cash outlay equals 0, what interest rate, because remember the things that are coming into play here, N, which is the number of periods of time, I, which is interest rate, and the principal, or the amount of the cash flows. So if you just flip that formula around and solve for an NPV of 0, that gives you what's called the internal rate of return. Again, I'll show you an Excel function that's called equals IRR, internal rate of return. It'll calculate it for you. But here's the idea. Smart Touch Learning's laptop project would cost $1 million with 5 equal yearly cash inflows of $305,450. So we use the following formula to find the annuity factor. Initial investment divided by amount of each year's cash flow. That gives us the annuity factor, 3.74. Then we can go back to our annuity table and we could say, okay, N equals 5. What interest rate is going to give me 3.274? And that's how we find the internal rate of return if we're using a table. Okay? If we're using it, and so if we're using Excel, it's going to give us a more exact number because we're not dependent on tables. Okay? So internal rate of return, if the internal rate of return meets or exceeds the required rate of return, it's a good investment. If it does not, then don't invest in it. It's that simple. To do internal rate of return when we have unequal cash flows is a little harder, as you can see, because again, instead of using the annuity factor, we have to use the single amount factor because it does different, this investment pays different cash flow each year. In the end, though, we can still do it because we have our net present value, and then we take our net present value, we put it in the formula, solve for the factor. We know what the number of periods is. You find the rate, the interest rate. It's not hard. I'll show you. You guys will love it. You'll love it. Believe me. You'll love it. North Korea, South Korea, they're going to be friends. You'll love it. Okay. So I'm not going to read this whole thing to you. but these are the strengths and weaknesses of each of the analysis methods. You can check it out in your book if you want to. And then, so the last thing, don't worry, that clock's fast, is we can use Excel to do all of this, like it says. They call it what-if analysis or sensitivity analysis. And in essence, all you're doing is you can say, here's my investment, here's my cash inflows, and then pretty easy, you can have it calculate the net present value, the internal rate of return. You could also have it calculate your payback and your accounting rate of return. You can look at all four of those side by side. And like I said, I'll briefly go over how to do that before you do your group work tomorrow. They're just showing you the functions. And like I said, I'll show you how to do it. And that's it. So I think this chapter is pretty doable. It's the last one. That's got to bring you joy and happiness and maybe a sense of peace and closure on this difficult chapter of your lives. Have a great day. What? Yeah, the next time we meet is tomorrow. So on a Monday, Wednesday, Friday class, tomorrow is always skip a day. No, you didn't get the message that we're meeting tomorrow? Special Saturday class? Okay.